Many households feel like their budgets suddenly stop working, even during years without a recession, job loss, or major emergency. In this video, we'll explain why household budgets break during what look like normal years, what's actually changing underneath the surface, and why this experience has become increasingly common. When people think about financial stress, they usually associate it with obvious disruptions, layoffs, medical emergencies, or economic downturns. But many households today feel strained without any single event to point to. Income may be stable. Employment may be steady. Spending habits may not have changed dramatically. Yet the budget no longer balances the way it once did. That disconnect is confusing because it feels like something is wrong, but nothing obvious happened. The central mechanism behind this is cost stacking without a shock. Household budgets used to rely on a buffer, a margin between income and essential expenses. Over time, that buffer has narrowed. Instead of one large increase, households experience many small ones. Rent rises modestly. Insurance premiums tick up. Utilities add new fixed charges. Services cost slightly more. Subscriptions accumulate. Healthcare out-of-pocket costs grow quietly. Individually, none of these changes breaks a budget, but together, they stack. At the same time, income growth tends to arrive unevenly. Raises are periodic. Bonuses are uncertain. Adjustments lag behind costs. This creates a slow erosion of flexibility rather than a sudden collapse. Budgets break not because of one mistake or one crisis, but because the system no longer leaves room for error. Households bear the full impact because they're the point where all costs converge. Service providers, insurers, utilities, and lenders each adjust pricing to maintain stability and cover rising expenses. Individually, these adjustments make sense within each system. But households experience them all at once, without coordination. No single entity accounts for total household capacity. Each only prices its own service. The result is pressure that feels personal, but is actually cumulative. Once a household budget breaks, it rarely fixes itself automatically. Costs that rise tend to stay elevated. Fixed expenses don't fall just because income stabilizes. Temporary adjustments become permanent baselines. At the same time, households adapt. They reduce savings, delay maintenance, rely on credit, cut discretionary spending. These adaptations keep things functioning, but they also remove resilience. The budget technically works, but only as long as nothing goes wrong. This makes normal years feel fragile, even without visible stress. For households, this means budgeting today is less about discipline and more about structure. Many people aren't overspending. They're operating in systems that leave very little margin. Financial stress comes from tight alignment, not poor choices. Understanding this helps reframe the experience. A broken budget doesn't necessarily mean failure. It often means the environment changed faster than income could adjust. Household budgets break during normal years because costs stack quietly and flexibility disappears gradually. This channel explains those shifts calmly and clearly, so everyday financial pressure makes sense, even when there's no single cause to blame.